What if you could look at a stock chart and understand the hidden story it's telling? A story of fear, greed, momentum, and reversal. That's the promise of technical analysis, the art of forecasting future price movements by analyzing past market data. But here's the problem. The world of technical analysis is vast and often overwhelming. Where do you even begin? In this video, we're going to cut through the noise. We're breaking down technical analysis into 8 core methodologies. Think of this as your roadmap, guiding you from the foundational basics to the more advanced prophetic theories. By the end, you'll not only know what tools are in the toolbox, but you'll also know which ones are right for you. Let's start with the most essential tool, the one you see on every chart: candlestick analysis, originating from 18th century Japanese rice traders. Candlesticks are more than just pretty visuals. Each candle packs 4 critical data points into one simple shape: the open, high, low, and close. A long green candle tells a story of strong buying pressure from the open to the close. A small candle with long wicks, known as a doji, signals indecision, a battle between bulls and bulls that ended in a stalemate. But the real power unlocks when you combine them. Patterns like the bullish engulfing or the evening star are like sentences formed from these candlestick words, giving you powerful signals about potential trend reversals. This is the first language of the chart. Now, let's zoom out from individual candles to see the bigger picture with chart pattern analysis. While candlesticks might give you a short-term signal, chart patterns reveal the broader narrative. They are the shapes and structures that form over days, weeks, or months. We have 2 main types. First, reversal patterns. Think of a head and shoulders top. This pattern forms at a market peak, showing a final push ahead before buyers exhaust themselves and the trend prepares to reverse down. Or a double bottom, which looks like a W, signaling that sellers have tried and failed twice to push the price lower. A potential start of a new uptrend. Second, we have continuation patterns. A triangle, or a flag, is like the market taking a breath. It represents a brief consolidation before the prior trend is likely to resume. Identifying these patterns helps you stay in a trend and avoid being shaken out by normal volatility. Our third pillar is all about direction. Trendline support/resistance analysis. The oldest mantra in trading is, "The trend is your friend." This methodology gives you a concrete way to identify that friend by simply drawing a straight line connecting a series of ascending lows. You define an uptrend and its support level. A break below that line can be an early warning that the trend is weakening. Similarly, connecting descending highs defines a downtrend beyond basic trend lines. This category includes tools like Fibonacci retracement, which helps identify potential pullback levels, and horizontal support and resistance, which mark key price levels where the market has historically reacted. Now, let's bring in the math. Our fourth pillar is technical indicators, the trader's dashboard. If the chart is the road, indicators are your dashboard gauges. They are mathematical calculations based on price and volume, designed to provide objective, quantifiable signals. The relative strength index, RSI, for instance, acts as your speedometer. It tells you when a stock is overbought, speeding, or oversold, stalling. Moving average convergence divergence, MACD, is like your momentum gauge, showing the relationship between 2 moving averages and volume. That's your fuel gauge, confirming whether a price move has the energy to continue or not. The key with indicators is to not overload your screen. Find a few you understand and trust. Speaking of moving averages, they are so crucial they deserve their own category as our 5th pillar. The moving average system. A moving average smooths out price noise, showing you the underlying trend. A rising 50-day moving average tells you the medium-term trend is up, but their real power comes from convergence and divergence. A common strategy is to watch for a golden cross. When a short-term average like the 50-day crosses above a long-term average like the 200-day, a classic bullish signal. The inverse is a death cross, which signals bearish momentum, because moving averages represent the average consensus of value over time. They become dynamic support and resistance levels. Our 6th pillar is the grandfather of it all. Dow Theory, developed from the writings of Charles Dow. This theory laid the groundwork for modern technical analysis over a century ago. Its core tenets are timeless. Markets move in trends. The trend is confirmed by volume, and indices must confirm each other. For example, a true bull market requires both industrial and transportation stocks to be advancing together. Understanding Dow theory gives you the philosophical foundation that all other techniques build upon. Now, let's venture into more complex territory with our seventh pillar, Elliott Wave theory. This theory proposes that crowd psychology moves markets in a predictable, fractal wave pattern. The core pattern is a 5-wave advance in the direction of the main trend, impulse waves, followed by a 3-wave corrective decline. The appeal is powerful if you can correctly identify which wave you're in. You can predict where the market is likely to go next. However, it's notoriously subjective. In real time, labeling waves is often called a game of 1,000 counts, where 10 analysts might see 10 different patterns. It's a powerful lens, but one that requires significant study and experience. Our eighth and final pillar is the most enigmatic, Gann theory, created by the legendary trader W.D. Gann. This approach is a unique blend of geometry, astronomy, and mathematics. Gann used tools like Gann angles and the square of 9 to predict not only where price would go but also when it would get there. While fascinating, Gann's methods are complex and often seen as esoteric. However, the most crucial takeaway from Gann isn't his prediction methods, but his famous 21 trading rules. He proved that even the most accurate forecast is useless without ironclad risk management and discipline. So, there you have them, the 8 pillars of technical analysis. From the simple, visual power of candlesticks and trendlines to the mathematical precision of indicators and the prophetic visions of Elliott and Gann. Your journey shouldn't be to master all of them at once. Start with the foundations. Become proficient in reading candlesticks, drawing trend lines, and using a simple moving average. Once you're comfortable, layer in an indicator or two to confirm your findings. The goal is not to find a holy grail, but to build a diversified toolkit. This allows you to analyze the market from multiple angles, increasing your confidence and your odds of success. Now I want to hear from you. Which of these 8 methodologies resonates most with you? Are you a chart pattern purist or an indicator wizard? Let me know in the comments below. If you found this guide helpful, smash that like button and subscribe for more videos that help you become a smarter, more disciplined trader. Thanks for watching, and I'll see you in the next video.